We are now going to go into what we call institutional economics. This is what I was discussing in the very first lecture that we had, and a particular aspect of institutional economics is adverse selection. So we're going to look at a number of cases, and then we're going to look at, well, there's no real true economic theory that applies here, but a lot of the principles apply, and institutional economists, they kind of agree with the neoclassical model, and they use it, but they have a little twist on it compared to the way that Paul Samuelson and others who established the neoclassical economics have done it. We will first look at some of the characteristics of institutional theory. The concerns of the institutional theorists are common to the actual situations encountered by firms and individuals in the real world. Consider some of these examples. Transaction costs are extremely important and must be taken into account. In fact, that was basically the thrust of what Ronald Coase, the Nobel Prize winner, had pointed out. Lack of trust leads to market inefficiency. Honesty is important when transacting. You need to know whether or not the car you're buying from a private individual or even a car lot, when it's used, that car is functioning the way they indicate it is. Third, economic agents are not totally selfish in all circumstances. The well-being of others often enters into the utility function. For example, I was recently on 11th Avenue near Maine, and I didn't have any money for parking, and someone agreed or kindly paid for my parking. Although it cost only $2, it saved me a lot of hassle, and I'm thankful for that. So we term this altruism. Economic agents possess information that others they are dealing with do not possess. Information is asymmetric. Again, looking back at the purchase of a used vehicle, that is certainly the case. Agents do not always act in the interests of society when working for government, for example, even though originally Paul Samuelson's models of neoclassical economics assumed that agents working for government were interested in society and acted always in the interest of society, in contrast to those working in the private sector. And contracting is extremely important here, and we're going to have a lecture on contracting a bit later on. Culture also plays a large role in the functioning of the economy, and that's usually ignored by neoclassical economists. In this regard, religion is extremely important, and societies that no longer teach such things as honesty are much worse off than those that do. Now, some of the terms associated with the new institutional economists and are to be examined in the lectures that follow include hidden information, hidden action. Hidden information is really an adverse selection problem, and hidden action is a moral hazard. Social capital, which is tied into culture and religion to some extent. Opportunistic behavior, asset specificity and the hold-up problem. Bounded rationality, principal agent theory, contracting and contingent contracts, trust and culture, as I mentioned earlier. So what is asymmetric information? Well, there's two types of asymmetric information, as I just mentioned. Hidden characteristics and hidden information are what we've usually termed adverse selection, and we'll talk about that much more in the slides that follow. Hidden actions, that's moral hazard. For example, a simple example of moral hazard is where once you've got insurance for your house, you don't take any extra steps to avoid being robbed, for example. Adverse selection occurs because differences among people are unknown to the decision maker. So some examples of adverse selection are as follows. A seller knows more about product quality than the buyer. Think again of the used car example. A worker knows more about her skills than the employer does. A manager knows more about production costs than the investor. A person knows more about his personal health than the health insurance company. And a student knows more about how much he or she studied for an exam than the professor does. So consider online reviews and adverse selection. Most consumers are very concerned about the unknown quality of durables such as laptops or ski gear or services such as tours and hotels. Adverse selection in this case is a big problem because as consumers we worry that low quality products and services are masquerading as high quality. Obtaining information about the experience and views of others who have previously bought the product and service is extremely valuable. And that's why it's important that people fill out these surveys that follow the use of say, an Airbnb. And firms such as Yelp capitalize on our demand for credible online information. And of course, there are fake reviews. Researchers have used artificial intelligence to develop software that can write extremely believable fake online reviews. And it's not just done there. I recall an editor of a journal telling me that she accepted a paper because she knew that the author would cite that paper, and the author was known to cite lots of papers, and that this would then raise her profile, the journal's profile. The tech is a major threat to sites like Yelp and Amazon. That is the artificial intelligence and the writing of these extremely believable fake online reviews and the business that they rely on. So these fake reviews are a threat to Yelp and Amazon. And it hints at a worrying future where artificial intelligence is capable of writing sophisticated texts, undermining public trust and spreading fake news. So how do we know whether a news story is fake or not? We often don't. It depends on how it's circulated on social media. That becomes extremely important, and sometimes fake news just seems to get worse and worse. Then we turn to market failure. Why do markets fail? Well, they fail primarily because of transaction costs. And one reason is asymmetric information. Insurance markets fail if low-risk people stop using insurance because of its high cost relative to perceived benefits. So young people, for example, won't take health insurance unless they're somehow forced to, as they are in Canada, but not in the United States. But it's the young people who are the ones that are less likely to use the healthcare services. Product markets fail if firms stop manufacturing high-quality products because the price premium they receive is insufficient. Why is the price premium insufficient? Well, there's not enough knowledge out there about the difference in quality from one product to another. Credit markets fail if borrowers are denied credit for projects of reasonable quality. Economists, of course, are interested in the market failure feature of adverse selection. They're interested in redistribution. Example, low quality products that are overvalued and high quality products that are undervalued. And then there's self-selection. Adverse selection is caused by self-selection, by those who have private information. If the self-selection is sufficiently strong, then the market fails because of the adverse selection. How people self-select into different groups on the incentive structure that is established by the transacting firm. So again, the example I offered about the young people not taking part in health insurance programs is really relevant here. And another example is that when offered an average wage, high-quality workers may self-select out of the labor pool, and low-quality workers will always self-select into the labor pool. And we'll look at some of those examples about low and high-quality workers a little later on. Some self-selection scenarios. If you offer a choice of deductible on an insurance policy, those who choose the low deductible are likely to be of higher risk. If a manager asks for volunteers for the night shift where supervision is minimal, those who are lazy are the most likely to request the position. If a firm offers an employee a buyout program to reduce its workforce, only the best workers who have good options to work elsewhere tend to accept. I know a professor who was at Berkeley, and they gave him an option to retire early. He did, took the buyout, and subsequently took a chair position at the University of Florida. Credit rationing occurs where lenders worry about raising their lending rate because it'll draw in more high-risk borrowers, in which case expected return on the loan may decrease rather than increase. So an adverse selection scenario is the one we were just talking about in terms of quality of workers. Suppose there are two types of workers. Good workers are worth $20 an hour to your firm. Bad workers are only worth $10 an hour to your firm. But you can't distinguish between the workers. What is the most it is willing to offer randomly to a chosen worker? Let me rephrase that. If you're going to look at a worker, you've got these bad and good workers, but you don't know which one the person who applied for the job is going to be. What is your strategy in terms of making an offer to a randomly chosen worker? How would your answer change if you knew that good workers will choose to start their own business if they are paid less than $18 an hour? So you got a bit of a quandary there, because a good worker may not take an offer of $18 an hour. So explain how adverse selection results in market failure. Just take a few minutes to think about how that occurs. The explanation is as follows. If good workers do not have the option to start their own business, then the maximum wage is $15 an hour and both workers apply for the job. Good workers are underpaid by $5 an hour and bad workers are overpaid by $5 an hour. But this cross-subsidization is not a market failure per se. The reason being it's more of a redistribution of income type of thing. So there's no self-selection out of the market by the high-quality workers. Adverse selection occurs and the market fails only if the high-quality workers select out of the market, leaving only the low-quality workers to apply for the job and to be paid the low wage. If the reservation wage of good workers is $18 an hour, as I discussed above, then there's a market failure. Good workers self-select away from applying for the job, and so a bad worker is hired with 100% probability rather than the 50% probability. That's if you're paying $15 an hour. Now there's a market failure because the worker is more valuable working for the firm than for herself, but yet she doesn't apply for the job. So the good worker doesn't apply for the job. You can also think about the problem as an asymmetric information, allowing low quality workers to select into the market to mimic the high quality workers in order to be paid a higher wage. In 2001, George Akerlof won the Nobel Prize for his work on adverse selection, and his story was about the used car market. He framed his story within that market, but the general results have implications for a wide range of scenarios, including prisoner dilemma games. It works as follows. If you are frustrated that you can't buy a can opener that continues to work past 3 months, you could describe the market dominance of poor quality can openers as a lemons problem. The word lemons refers to a situation where the product or service looks fine from the outside, car looks great, but after the purchase is made, the product reveals itself to be of low quality. The car is a clunker. This was the angle that George Akerlof took. Now what's interesting is his paper was rejected by about 3 or 4 top journals before it finally found a home, and it basically earned him the Nobel Prize in economics. So let's look at the used car market a bit. Used car buyers know there are 1,000 high quality cars and 1,000 low quality cars on offer. Buyers are willing to pay up to $4,000 for a low quality used car and $8,000 for a high quality used car. Low quality owners will accept any price for their cars, and high quality owners have a reservation selling price equal to, let's say, R high, so reservation high, RH. With perfect information, buyers will offer to pay $4,000 to owners of low quality cars and $8,000 to owners of the high quality cars. So the reservation price, that RH for high quality, is critical in this analysis. Like the worker quality story told above, a critical parameter in the model is the reservation selling price for the high quality car owner. If the reservation selling price is below the average value of low and high quality cars, so the average between $8,000 and $4,000, so $6,000, then the high quality owner will accept an average price. In this situation, the high quality owner cross-subsidizes the low quality owner, but there is no self-selection and thus no market failure. If instead the reservation selling price of the high quality seller is above the average value of low and high quality cars, then there will be self-selection out by the high quality car owners and the market fails. So we're going to look at some of the details in this regard. So asymmetric information is the problem. With asymmetric information, buyers cannot distinguish low and high quality cars. If the buyer believes that 1,000 low and 1,000 high quality cars are on offer, then the odds that a randomly selected car is of high quality is 50%. Further, we assume a low quality car sells for $4,000 and a high quality one for $8,000. Then the expected value of the car to the buyer is $6,000, half of $4,000 plus half of $8,000. The buyer knows the value of his or her reservation price, RH, and rationally understands that high quality sellers agree to the offer of $6,000 if the reservation price is less than $6,000, and will choose not to sell if the reservation price, if their reservation price, that is greater than $6,000. In this latter scenario, the buyer will then revise her thinking and believe that the only cars being offered for sale are low quality. In this case, the buyer will offer to pay $4,000 rather than $6,000, so they know what the price of a low quality car is going to be. Now assume that the reservation price is less than $6,000, so that the sellers of high quality cars agree to the buyer's offer of $6,000. Asymmetric information implies the high quality seller receives $6,000 rather than $8,000, and the low quality seller receives $6,000 rather than $4,000. So asymmetric information results in the high quality seller cross-subsidizing the low quality seller by $2,000. This cross-subsidy is an internal transfer that does not affect the total market surplus. So there's no deadweight loss when the reservation price is below the average of the high and low quality cars, or less than $6,000. So when does the market failure occur? Suppose that the reservation price lies between $6,000 and $8,000, in which case the high quality seller will choose not to sell if offered the average price of $6,000. So buyers cannot distinguish car quality, but they know the value of the reservation price. Buyers understand that the only cars on offer are low quality. All right, so if they can't distinguish the car quality, but they know the value of the reservation price of the sellers of the high quality cars, then they understand that only cars of low quality are on offer. Consequently, buyers revise their offer down to $4,000, and low quality sellers will accept this offer. The used car market now consists of only low quality sellers. High quality sellers have self-selected out of the market, which results in market failure because there's no trade in high quality cars. Now these examples can get more and more complex, of course, because in the previous example what we assumed was knowledge about the buyers had knowledge of the reservation price of the sellers of high quality cars. So let's consider the previous example, but now suppose a fraction Q of the cars are known to be high quality and fraction 1 minus Q are lemons. So a buyer's expected value of a randomly chosen car is now given by the expected value of 1 minus Q, so the probability of a poor quality car, times 4,000 plus the probability of a high quality car times 8,000. The high quality car owners choose not to sell if the expected value of the car is less than the reservation price of the high quality sellers, or the sellers of the high quality cars. So the market fails if this 1 minus Q, so the probability of the seller selling a low quality car times 4,000 plus probability of a high quality car times 8,000 is less than that reservation price of the high quality seller. So we rearrange this equation, and then it turns out that the market fails if the Q, the probability of being a high quality car on the market, is less than the reservation price minus 4,000 divided by 4,000. The lower the fraction of good cars, the lower reservation value must be to avoid an adverse selection outcome. So let's look at another example where we have three types of workers: low, medium, and high. Their value to your firm, the reservation wage, and the probability of being selected are shown in the table below. So a low quality worker, the value to your firm is $12 an hour. A medium quality worker's value is $16 an hour, and a high quality worker is worth $20 an hour. The reservation wage for a low quality worker is $12 an hour. We don't know in this example what the reservation wage is for a medium quality worker. We're going to calculate that. And a high quality worker has a reservation wage of 18. And let's say that the proportion of low quality workers is a half, and each of the medium and high quality workers, the proportion of them going into the marketplace and approaching your firm is a quarter for each. So the expected value of a randomly selected worker to your firm is given by multiplying this 0.5 times 12, adding 0.25 times 16 and 0.25 times 20 gives you $15. The highest wage you would offer to a worker applying for the job is thus $15. The reservation wage for a high quality worker, let's say, is $18. Your revised calculation of the expected value to your firm would be what? Given that the reservation wage of the high quality worker is 18. Give you a minute to think about that. Let's look at the answer. We have not used X to move forward with the problem yet, so let's let V star be the solution to the previous question. In equilibrium, only the low quality worker will apply for the job and be paid a wage of 12 if what? X is less than or equal to 16, X is greater than 16, or X is less than or equal to V star, or X is greater than V star. I'll give you a minute to think about that. So you see, you haven't been able to solve the first problem yet, but at least you were thinking about it. Now you need to look at the second problem, and we will be able to give you an answer to that. The answer is V star is 13.333. So that implies that X greater than or equal to V star, and it has to be greater than 13.333. All right, let's look now at medical insurance in the US. Medical insurance, I've already been talking about this, but the medical insurance companies worry that healthy, low-risk people will self-select out of buying health insurance. That's the main problem. This self-selection raises the frequency of claims within the pool of health insurance applicants. So insurance companies compensate for this by raising the price of the insurance. But the higher cost of the insurance causes more low-risk people to drop out. This causes the insurance company to raise rates even more. The cycle continues until an equilibrium is eventually reached, as it is in the US, and the market fails because many people end up without medical insurance. And this is exactly what has happened in the US and why the Obama Medicare program and all these programs have been tried there. And it's the reason why Canada has the kind of insurance policy that we have. The only problem is when the government starts to fiddle with the insurance program, it then also fiddles with the price to keep it down low. And as a result of fiddling with the price of health insurance, it doesn't fund the insurance to the proper level required. Adverse selection in food safety. Consumers often cannot distinguish food safety from potentially risky food. Riskier food is cheaper to manufacture, and consumers tend to purchase lower-priced food. The firms manufacturing the safe food must lower their price in order to compete because people can't tell the difference between the safe food and the potentially riskier food. And they cannot cover the added expense of making the food safe themselves. So the market fails. Firms making safe food are driven out of the market and only potentially risky products remain. So here we find a role for government. We have market failure. Government needs to step in to do the inspections. So how do we reduce adverse selection? Well, there's two general mechanisms for doing so. One is to restrict opportunistic behavior, and the second is to equalize information. Different methods have their pros and cons, and which one works best depends on a variety of factors, including the cost of regulation versus the cost of acquiring information. How do we reduce opportunistic behavior? Adverse selection in insurance markets is often eliminated by making insurance mandatory. As I pointed out, car insurance in BC, Obamacare in the US. The case for car insurance is a little weaker given evidence from other provinces. The mandatory insurance prevents the low-risk people from self-selecting and opting out. It prevents an outflow of low-risk customers, allowing the insurance company to keep rates relatively low. But it's better to have cross-subsidization than a fraction of the population not being insured. That's the argument that is used in these cases. Reducing opportunistic behavior, on the other hand, in the market for product quality, for food safety then, opportunistic behavior is reduced by regulating firms to adhere to production standards. This is especially important for product safety. When product safety is not a concern, then it is largely buyer beware. Most people have stories where they purchase products that appear to be good, but they've turned out bad. And of course, the other one that is I mentioned about opportunistic behavior was the fact that you took the government began to do food safety inspection. So equalizing information, it's common for firms with limited information to screen to gain more information. So they screen employees, they screen for products and that kind of thing. And of course, these reports on or reviews that you see on websites are important as well. Insurance companies typically offer a base insurance plus additional riders. Okay, that's how insurance companies can deal with this. People who select the voluntary riders reveal information about themselves. Homeowners who choose the sewer backup rider, for example, typically live in flood-prone areas. This allows for better matching of risks with the price of insurance. Signaling. People with private information may try to convey information by signaling. In the Lemons story about low quality and high quality automobiles, the low quality sellers do not wish to signal the quality of their cars. But in contrast, the sellers of high quality cars have a strong incentive to signal that their product is of high quality. If the signal is effective, high quality sellers can distinguish themselves from low quality sellers. And this will allow the high quality seller to be paid the $8,000 rather than the $6,000. Signaling reduces the adverse selection problem, but it's costly for the high quality firm. The gain from being distinguished as high quality must more than offset the cost of the signal. Signals only work if the cost of the signal is relatively low for high quality agents and high for low quality agents. Otherwise, low quality agents would simply mimic the high quality agents. In a credit market, borrowers often offer collateral as a signal of their quality. All right, think of it. You're often asked to provide collateral. For example, if you're buying a house, you have to put a certain amount down. But collateral is costly to offer because it might be lost in the event of bankruptcy. So high-risk borrowers, therefore, may not be willing to offer the same amount of collateral as that offered by low-risk borrower. In the case of purchasing a house, some people just can't afford to pay the down payment. Or they take a loan at a higher rate, but also at that comes with a lower down payment. So banks will infer that those who offer high collateral are low risk and those who offer low collateral are high risk. And then the adverse selection problem disappears because the person who is offering a small down payment but pays a higher interest rate on the mortgage would be less likely to get into such a situation compared to a person who has a large down payment. They would pay a smaller interest rate or a lower interest rate on the subsequent mortgage. And that's a way that adverse selection is knocked out or at least mitigated. Other examples of signaling. Ask yourself what you might choose as a signal in the following situations and why it could possibly work. Suppose you're finishing high school and are worried that future employers cannot distinguish between high and low quality workers. So what would you do? Well, one way, of course, is grades. How were your grades compared to those of others? The other way, of course, is that you do volunteer work, or that you show that you have been an athlete, or that you've done this, that, or another thing over and above what you did in high school. Suppose you're purchasing insurance and are asked about the size of the deductible. What would you like? Well, in this case, the higher the deductible, the more the insurance company is willing to take you on for obvious reasons. Suppose you're selling computers and are worried that consumers cannot tell that your product is above average quality. Again, what would you do? Okay, some explanations. I already started these. Work quality, post-secondary education is the signal. All right, I came up with some other ones. It works because it's more costly to acquire a low quality worker versus a high quality worker. Insurance deductibles are similar to collateral explanation. A low deductible serves as the signal. High risk people find it more costly to choose a low deductible than low risk people. And product quality. A longer warranty serves as the signal. Low quality manufacturers find it more costly to offer the longer warranty. And finally, looking at reputation and standardization, high quality firms must develop strategies to overcome the adverse selection problem. A firm works hard to achieve a strong reputation of high quality so that consumers are willing to pay a premium for its product, even if the product cannot be distinguished from low quality products. Firms may also offer warranties to back up their claim of high quality. Companies often standardize their products to reduce the severity of the adverse selection. This explains why tourists in a foreign city are attracted to McDonald's.